Welcome to Global Insights with me, Punita Kumar Sinha. Today we will focus on Europe, which is one of the biggest risks facing the global economy because of the huge debt problem in several countries like Greece, Italy and Spain. The crisis in Eurozone threatens the financial system worldwide. So will the Eurozone fall apart and what damage will that cause? To understand the European crisis better, we will be joined by Professor Raghuram Rajan, one of the world's leading economists, and my colleague's classmate from IIT Delhi. So where is the Eurozone headed? What solutions are possible and how will this impact India? First, let's take a look at how bad things are in Europe. Nikhil Shivadas has this report.
The writing is on the wall. The Eurozone is on the boil and has been that way ever since the crisis in Greece began 2 years ago. Today, several of the 17 Eurozone member nations are grappling with high government debt, stagnating GDPs and unemployment levels touching an all-time high.
Exceptionally high risk premia are observed in government bond prices in several countries, and financial fragmentation hinders the effective working of monetary policy.
The problem is not just an economic one, but a political one too. While stronger nations like Germany are being urged in to bail out the weaker members like Spain, Italy and Greece, there is little consensus on the matter. And that's the trouble. The European Central Bank is doing all it can to tide over the storm. But it's not going to be easy.
Part of the problem with the euro is that some credibility was impaired because quite often we said we would do certain things and then didn't do them in practice, and this credibility has to be regained.
Bailouts seem like the easiest solution, but they are not finding favor with the stronger members of the Eurozone, and justifiably so.
The real problem in Europe is the bailouts are just continuing, and so people expect that and therefore don't make the necessary adjustments.
If these necessary adjustments are not made, there is only one solution to the problem: to break up the Eurozone.
The short-term solution is for Southern Europe to leave the euro, devalue, so places like Spain, Greece, to a certain extent Portugal, leaving the euro, devaluing, defaulting on their debt, that's an inevitability, and then starting their growth process again.
But before that growth process starts, several economies in Europe will have to painstakingly build themselves again with structural and financial reforms. And that could take years altogether.
So a grim situation ahead for the Eurozone. What is the way out? Raghuram Rajan, former chief economist of the IMF, professor of finance at the University of Chicago's Booth School, and soon to be chief economic advisor to Government of India, joins me to discuss that. Raghu had warned the world on the global financial crisis even before it began. Raghu, can you tell us your views and perspectives on the structural problems facing the Eurozone today and over the next several years?
Well, the fundamental problem is of very slow growth. It's augmented by problems of very high debt and differential competitiveness within the Eurozone, combined with the fact they all have one currency. So put it all together, they really have to find good policies to get them out of this, especially in an environment where the banks are crippled by the holdings of government debt, governments are crippled by the relatively slow growth and the huge debt that they have. They need to find a way out of this, and there are no really easy solutions.
Given the slow growth, what do you support for reducing the Europe's debt crisis? Austerity by way of cutting social expenditure and raising taxes, or stimulus for growth?
Austerity clearly is not a prescription for growth in the short term. It is negative for growth. It hurts your growth prospects. So where do you find growth if you can't engage in government spending at the level that you were before? It has to be through a variety of reforms which energize the private sector and get it going. Now, in the meantime, of course, you want to try and keep austerity at a level that doesn't become paralyzing. You need austerity because government debts have blown out too much, but you don't want to have that level of austerity that you get riots on the streets, and that the economy itself is paralyzed, which means that whatever government spending you can undertake has to be targeted very, very effectively at the weaker segments of society, the elderly, people who are in real need, so that the economy doesn't, implode and people suffer tremendously.
You're in favor of stimulating for growth. How long would you stimulate?
No, I'm not saying necessarily stimulate, because when you think of stimulate, people usually think of big government spending programs, construction, things like that. The problem in countries like Spain, for example, is too much construction. They've built airports they don't need. They've built lots of housing they don't need. So an additional dose of construction is probably going to be unwarranted in a country like that. What I'm saying is that be careful on how you cut spending. You do have to cut spending somewhat to convince the creditors, to convince the markets that you are bringing your deficits under control, and longer term you're good for your money, so that the debt doesn't implode. Austerity tends to shrink growth, so you want to be careful about how much austerity. But less austerity is not a prescription for long-run growth. What is really a prescription for long-run growth is structural reforms, and that's what they need to do more of.
So then what is your view on dealing with the banking crisis in countries such as Spain or Greece? Who should bear the pain of debt write-downs?
Clearly, strengthening the banks is step one in the process of recovery. Now, there are 2 or 3 elements to this. One is allowing the banks to continue borrowing, and that the ECB has focused on with its LTRO program and so on. It's been moderately successful on that, but it hasn't sort of re-energized lending between banks. Right now, many banks essentially are on life support from the ECB, especially in the peripheral countries. The second element of the bank package has to be recapitalization. You have to put more money into banks that are in deep trouble, and money can come in 2 ways. One is new equity infusions, and typically this is not going to be easy to raise from the markets, so it will have to come from some quasi-official agency. But also you can create effective equity by writing down debt, which is what you talked about. I think there is no question that any solution in Europe will have to involve writing down a fair chunk of the subordinate debt in these banks, primarily because there isn't all infinite capacity for the governments to put more equity into the banks. So there has to be some private sector contribution, and typically that private sector contribution comes from partly a write-down of existing equity, but partly a write-down of existing subordinate debt. The last element, which I think is quite important, is insurance, because deposit insurance. Because the worry if you're a depositor in Spain is not so much whether your bank is solvent if you're in a large bank like Santander, but it is whether Spain goes off the euro and overnight your euro deposit becomes a peseta deposit, or if it's in Greece, a drachma deposit. And given the drachma, the peseta is expected to depreciate very quickly against the euro, that's not something that you necessarily want. You have to assure depositors that the euro value of the deposit is protected. And this kind of assurance can't come from the country. It has to come from euro area entities.
You're right. Deposit insurance and recapitalization could help. And if you look at the data today, with no deposit insurance, money is actually flowing into the strong countries, both equities and bonds, say for Germany and France, where the yields are at record lows on the bonds, and flowing out from the big debtor countries like Italy and Spain, where the yields have shot up. So what else would you need to do to solve the clear divide in bond yields in the Eurozone nations?
Well, if you can convince depositors that their money is good and it is backed, then I presume what you will see is a reverse capital flight as money comes back from the sort of center countries or northern countries back to the periphery countries in a search for yield, and brings down the yield in those countries. But at some point, my guess is there will have to be a firewall that is erected around the parts of the euro area that the euro area thinks are salvageable. and that firewall has to be very high, and it will include things like deposit insurance if it is to make a successful go of it.
Raghu, I also want to ask you about the several situations that could emerge if Greece does exit the Eurozone and whether the Euro will survive at all. But we'll talk about that and more on the other side of this break. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. And we're discussing the Eurozone crisis with Raghuram Rajan. Raghu, there are several scenarios that can happen here. A Greek exit from the Eurozone, a Greek exit along with the exit of other peripheral countries such as Portugal, Spain, etc., and a closer banking and fiscal union with debt mutualization, resulting in a more federal Europe. Which of these three scenarios do you think is most likely, and which would you think is best for the global economy long term?
Well, I think from the perspective of the global economy, the least disruptive still would be one where eventually there is debt mutualization, but also there is concerted effort at reform in the peripheral countries. So a bit of debt guarantee, debt mutualization from the core in return for strong reforms from the periphery, which would generate over time both growth and stability, which is really what's in the world's best interest. I think if the form in which that could be carried out would be some kind of program which the North sort of insists the South commit to undertake, something like an IMF program where it says we will do ABC in return for regular sort of monetary support. Is that the most likely? There is a reasonable probability that the political incentive to stay together and to continue as a solid euro area will overcome some of the economic costs and which prevent this from happening. And so there is a reasonable probability this could happen. But I wouldn't put it north of 50%. I still think that it's in that range. Greece, of course, hasn't delivered on many of the promises it has made, and if it wants to renegotiate the debt terms without fulfilling the promises, it's going to be very hard for some of the northern countries to agree to that. So I think Greece is probably the sort of the trigger point for at least some shrinkage in the euro area, with Greece being the most likely exit candidate. Not to say that they can't revise what they're doing and stay in. It's just that if there is a point at which it could break, it would be Greece. I suspect that if that happens, there will be a rethink on what the measures they have for Spain, for Italy. And it is possible that if there is a Greece exit, that could be the Lehman-like event which makes the euro area come together and put in sort of safety or protection for Greece, for Spain, Italy, and Ireland. But that remains to be seen.
Raghu, when I started my investment career, there was no euro and the markets worked fine.